Our next guest knows a thing or two about media as a former executive of both Hulu and Netflix. Let's bring in SPG's Simon Gallagher for his take on Disney's quarter. Simon, great to have you with us.
Great to be on.
It sounds like you're more concerned about the decline in its legacy business and the ability of the new business to sort of offset that.
Yeah, look, I think so. You're looking at the Disney Plus business not necessarily turning a profit until 2023. It's still a long way out, and the rapid decline of the broadcast and the network and the broadcast networks and also the pay TV channels, it's happening very rapidly, and I'm not sure that the Disney Plus business is going to lift the numbers fast enough to offset that decline.
But eventually, do you think they will?
Look, they're predicting some very big numbers. I think that Disney has always had a great business, but do I think it can? Look, I'm not sure. I'm very optimistic. What Disney now is, though, with the Fox acquisition is this really global business. I love the fact that they've acquired Hotstar in India as part of the Fox acquisition. So there's some new businesses coming into the fray that I think maybe the analyst community hasn't looked at too deeply that may start to see them re-rate Disney a little bit.
Hey, Simon, it's Tim. Thanks for joining us. And I'm not asking you to play trader, but we talk about Netflix all the time, and we just talked about Netflix where there is no profitability. There's a major cash burn, and people and investors have been willing to give the company the benefit because they're banking on essentially this distribution and effectively certainly a leadership in terms of that pipeline. Talk about that and bring it back to Disney, which doesn't necessarily for the market have to be profitable on that core business right now.
Sure. Look, Netflix, I think, and I said this last time I was on the network, are very clever about bringing down that PE ratio. It's, I think, 92 today, and I think you're going to see that PE ratio come down over time. Reed Hastings yesterday on DealBook and on the network was heard to say, we're going to continue to spend, but I think they're going to continue to spend sensibly. So they will still spend a lot of money on high-profile shows, but they're getting smarter and smarter about the volume of shows that they need. And some assets, they can curate the roster, so to speak. So they can bring down what shows are not necessarily performing for them and spend more on other shows. So you have to, I was thinking about in preparation for the show today, I was thinking, would you rather be managing a declining broadcast and pay TV business at Disney, or would you rather be trying to manage to bring your PE ratio down in Netflix? It's an interesting challenge of both businesses.
Simon, excuse me, thank you very much for your time. It's great to have you.
Thank you.
I'm so happy that he plays Would You Rather.
You can do it at home.
Would You Rather
Holy cow.
at home.
Awesome.
I think it's a good sign.
Groundbreaking television here, Fast Money.
Why are you looking at
What's
me?
that face? I thought that was really interesting. I mean, I think here's the issue. They have no choice. They have a declining media business. And so why is Bob Iger still in the CEO seat? They've made some huge bets over the last few years as he's extended out his tenure, and he's going to see this thing out. So it's going that way one way or another. And I suspect that we're not done seeing consolidation among media assets. You know what I mean? Like, there's probably more for them to buy. They're going to probably buy an EA or something like that. Let's really broaden out all of this content, right? And be a one-stop shop on multiple mediums. So that's, I suspect, the bet that's going to be going on for Disney for decades.